Hello, Alexander here again. This is chapter 16, 4 problems on statement of cash flows. So I picked a few small ones. So for here, PE 16-1A, classifying cash flows. These two back-to-back ones are great for just knowing where to put things. So as either investing, operating, or financing. So A, retirement of bonds payable would be a financing activity. B, payment of accounts payable would be an operating activity. C, issuance of common stock would once again be financing. D, payment for administrative expenses would be operating, just one of the day-to-day things. E, cash received from customers would be operating. F, purchase of land would be investing activity. And then on to the next one, which is another classifying cost. A, issuance of bonds payable, financing activity, has to do with bonds. B, cash sales, operating activity. C, collection of accounts receivable, that'd be operating activity. D, payment for administrative expenses, operating activity. That's just day-to-day operations. E, disposal of equipment, that'd be investing activity. F, purchase of investments, investing activity. So I love these ones where it just kind of helps you know where which goes. Alright, 16.3a, changes in current operating assets and liabilities, indirect method. So we have a net income of $138,000. Our accounts receivable decreased, which means we added. We had an increase in inventory of 2,100. Oh, the decrease of accounts receivable was 4,500. The increase in inventory was 2,100, which we deduct because it went up. An increase in accounts payable of 1,650. We add because money we're not paying. A decrease in dividends payable of 3,000, which we deduct. So we take the 138, add it, subtract it, we end up with $139,050. And so as you can see, as receivables go up, we lose cash. As they go down, we gain cash. Inventory goes up, we lose cash. It goes down, we gain cash. Accounts payable goes up, we gain cash. Goes down, we lose cash. And the dividend, anything payable is the same as accounts payable. Okay, next one, PE 16.4a, cash flows from operating activities, indirect method. So we start with net income, $168,750. Depreciation expense, we had $18,750 of depreciation expense. We add that. Always add your depreciation back into your net income because it's not cash we're spending. That's how you got to think of depreciation. It's not cash. It's just lowering our income. A lot of stuff does that. Gain on disposal of equipment, we deduct. Gains, you subtract out because a gain doesn't mean anything. It's not cash we received necessarily. And the same with a loss. A loss on disposal, we add back in because it's not necessarily cash we've lost. Losses and gains are just, all they do is affect the income. And then decrease in accounts receivable, which means an increase of 10,500 because that means customers are paying on their accounts, we're getting cash back. And then a decrease in accounts payable means of 2,700 means we lost money. So these are just short problems to I want to explain on the operating, specifically how each one goes up and down in the exact opposite of what it would make sense. So that's why it's hard at first, but then you get used to it and you start learning, oh, okay, you connect the cash flow to what's actually going on in each part, what's happening to your cash. And this is just the operating. So if we went on to, let's say financing, investing next, if we purchased land, it'd go down here. And if we purchased land, we deduct how much the land was. If we sold land, we would add how much we got. But the gain or the loss on the land goes up here. Always. So remember to split that up, put the gain or loss on it up here. And then down at the financing, the last one, if we issued stock, our cash would go up by how much? If we bought stock back, like treasury, our cash would go down. And so that's the basic idea of the cash flow statement in the three scenarios. It seems like it's a lot, but it's not really once you break it down and you're seeing what's going on. It's a piece of cake. So the cash flow is a great learning activity. It really shows you how an income statement is actually not always that true, because there's things that increase your income that aren't cash, and there's things that decrease your income which aren't cash. And so the cash flow, always look at the cash flow. Great statement. So thank you. The next chapter is the last one for 202, and I'll probably go on to either governmental. I'll start maybe hitting the governmental up, or the auditing. That's so many I could do. I could do taxes, but please feel free to like, subscribe, comment, and what have you. And thank you so much. And I just love trying to make a difference, a little bit I can. So thank you, and I'll see you all next time.